Well, good morning, Jaginder Rana here. So, the topic for our discussion today is contractors, plant and machinery insurance. Contractors, plant and machinery insurance. There are number of vehicles which comes under the miscellaneous D category of the India Motor Tariff. There is a list given in the India Motor Tariff wherein almost 58 miscellaneous kind of vehicles are included. Some of the vehicles may be known to you, but most of the vehicles are not even heard. So these are the machineries which are called vehicles, equipment, machineries, etc. For example, agriculture tractors, ambulance, angel dozers, rippers, road rollers, bulldozers, bull graders, cinema film recording, compressor, crane, delivery trucks, dispensaries, excavators, fire brigade, footpath roller, forklift, grapes, gritting machine, hearsay, tippers, scrapers, etc. They are all insurable. If they are registered under the RT provisions, then they are insurable under the Motor Vehicle Act, under the motor insurance policies. If they are not registered, then CPM insurance. As far as the definition of CPM insurance is concerned, CPM policy covers all types of contractors, plant and machinery or equipment engaged for work at any specified location in India. So at any plant site, the contractor is completely dependent on the machinery and plant work. Physical loss or damage to these equipments can lead to heavy loss as they require huge investments. So the insurance can keep the contractor relaxed because his or her machinery and plants are protected against any damage or loss. Normally this policy is divided in two sections. Section 1 is material damage and section 2 is third party liability. So material damage section covers any unforeseen and sudden physical damage to the property by any cause not specifically excluded. So causes like all risk insurance subject to named exclusions, machinery at work or at rest, subsequent erection, machine being dismantled for the purpose of cleaning or overhauling, machinery when being shifted within the premises, are all covered under the material damage section. Then the section 2 covers the third party liability. This third party liability covers the property against loss or damage or destruction by any cause. Rate schedule is absolutely different because in CPM it is not like motor insurance policy because there are 6 groups are there and the rates for every group is fixed. So for example, group 1 the rate is 0.60%, group 2 0.80%, group 3 1.00%, group 4 2.00%, and group 5 0.20%. So 5 groups are there only. These 5 groups include all kind of machineries. Earthquake extra can be charged, otherwise this is the rate applicable with all the general insurers. And a group of machineries are classified into 5 groups. So in first group you will find the machineries like chain blocks, compressors, conveyor belts, crane up to 10 ton capacity, concrete pumping plant, cement silos, railway trackers, scrapers, road rollers, portable protection tents, like that. What happened actually, these all machineries are coded. So under the group 1 the machineries are coded like 101, 102, 103, etc. Rate is 0.60% plus earthquake. Rate is dependent upon the insurer. Whatever detailed discount they can provide. Then group 2 includes machineries like aggregate plant, airlocks, gas power generating plant, graders, pen scrapers, trippers, locomotive field and steam generating engines, mobile mixing plant, mechanical sweepers, tractor, trailers, stone crushers, etc. So under this category, the machineries are coded like 201, 202, 203 like that. Rate is 0.80% and earthquake extra. So this is group 2 of the machineries. Group 3 includes machineries like bulldozers, crane above 10 ton capacity, diving equipment, excavators, loaders, mobile driving rings, top lift trucks, breakdown vehicles, hydraulic twin booms, etc. So the machineries are coded like 301, 302, 303, and being this group third, rate is 100% plus earthquake. So this is group 3. Coming to group 4, group 4 includes heavy and risky machinery like a drilling machine for water supply, tunnel boring machines. They are coded like 401, 402, 403, and the highest rate is charged for this group, that is rupees 2.00% plus earthquake. So group 5 is on the contrary, the lowest rate is there because other miscellaneous items with individual value up to rupees 10,000 are included in this code, in this group. Some of them are not self-driven. They are either mounted or connected, then only used. So this group 5 has the codification like 501, 502, etc. and rate is only 0.20% plus earthquake. Earthquake rates are on the pattern of the fire because there are 4 zones. Group of machineries of zone 1 are having the earthquake rate of 0.10%, inclusive of all acts of God perils except earthquake. So zone 2 0.05%, zone 3 and 4 0.02%, and 0 for group 4 0.01%. So rate variation is according to the frequency of the earthquake in that area. So this is divided into the 4 zones. Now decline risk. So all the insurance companies are having their own decline risk because certain machineries which are giving the high claim ratio, companies used to decline them because they are affecting their profitability directly. Say for example registered vehicles, because they are insured under the motor insurance policies. Then agriculture equipment, tunnel boring machines, all types of underground risk, waterborne machineries, oil, gas and drilling rigs. This decline risk is not mandatory. This is depends upon the insurer to insurer. They may cover the risk according to their desire, and if the risk is offered with certain other coverages or other policies. Normally these proposals are declined. Adequacy of sum insured is the most important part of this policy because sum insured shall be equal to the cost of replacement of the insured property by new property of the same kind and same capacity, which shall mean its replacement cost including freight, dues and custom duties, if any, and erection costs. Then transit coverage is another important feature because the risk during shifting of items of contractors' plant or machinery or equipments in connection with the work at the project site from one point of the project site to the another point in the same project site is deemed to be covered within the prescribed dates. But transit risk from site to site will be excluded. However, the transit within the covered premises will be covered under the policy. So normally for this kind of risk, either the machineries are carried through the through the marine transit policies or the loaders. Loaders are used to carry. Certain companies are providing this transit coverage as an add-on cover to the policy. So other add-on covers available with this policy are third-party liability, owner's surrounding property, clearance and removal of debris, additional custom duty, express freight, air freight. Premium rate differs company to company, and even the number of add-ons differs company to company. But these are the most common add-on covers which are available with almost all the insurance companies. This CPM policy does not cover the loss or damage caused due to electrical and mechanical breakdown. Because failure or breakdown or derangement, freezing of coolant or other fluid or defective lubrication or lack of oil or coolant are not covered. Secondly, loss or damage caused due to explosion of boiler or pressure vessels, because there is a separate policy of boiler and pressure vessels. The normal wear and tear or replacement parts like knives, drills, bites, batteries, tires, ropes, chain, etc. They are all normal wear and tear. War and warlike operations, loss or damage caused by nuclear reactions, loss or damage to machine in the course of transit, because transit risk is excluded. These are the exclusions of the policy. As far as claim settlement is concerned, it could be of two types. In case of partial loss, the insurer will provide full cost of replacement of parts plus repair charges, then cost of dismantling and de-erection. Depreciation is applied only for the parts with limited life. If the repair work are undertaken by the insured, actual material and labor cost plus a reasonable quantum of overhead is payable, salvage is deducted. And if the sum insured is not adequate, in that case condition of average will apply and the claim will be paid proportionately. Similarly, the case in case of partial loss, because the new replacement value, in case of total loss, the new replacement value of the item immediately before the occurrence of loss, less salvage and less depreciation subject to adequacy of sum insured. This is the way of settling the claim. One most important aspect is that how to differentiate the motor or CPM policy, because this is a major differentiating factor in the motor and non-motor category. See, motor policy has the vehicle classification like motorized two-wheeler, three-wheeler, private car, commercial vehicle, goods carrying commercial vehicle, passenger carrying commercial vehicle, mixed class D vehicles like tractor, trailer, excavator, crane, dumper, road roller, etc. But CPM vehicles which are on project site comes under the CPM tariff, and machines classified are into 5 groups, group 1, 2, 3, 4, 5. Even the rates are prescribed. In motor, named peril policy. In motor is a named peril policy where 10 perils are covered under the policy, and any loss occurring due to the fire, explosion, self-ignition, lightning, burglary, by STFI, accidental external means, terrorism are covered under the policy. But here in CPM policy, this is known as all risk policy. So cause of losses which are not excluded under the policy are not payable. The cause of losses which are not excluded under the policy, they are all payable. All other losses are means if the loss is excluded, then it is not paid, otherwise all losses are covered. Additional covers such as earthquake, owner, surrounding property, third party liability, terrorism, floater covered by payment of additional premium are covered. Overturning is a default inbuilt cover unless excluded explicitly. But in motor category, overturning can be covered by payment of additional PM. And a very minute excess clause is there in motor insurance, while in CPM excess is very high. It starts from 12,500. Moreover, the motor insurance is governed by India Motor Tariff 1989, while CPM is governed by CPM tariff. Vehicle meant for public use and passenger or goods carrying comes under the purview of motor insurance, while vehicles meant for limited use and for specific purposes such as excavation, harvesting, drilling, etc. are covered under CPM. So all vehicles meant for road use compulsorily registered with the RTO are insurable under motor insurance. But CPM generally used at single location need not be registered. It coverage restricted to the project site only. Inter-site movement, whether it's self-propelled or transit by any mode, is not covered. In Motor C, compulsory third-party liability insurance is there, and that compensates under TP liability is for bodily injury unlimited. Third-party property damage is up to 7.5 lakh. But in CPM, third-party liability will be given at the request of the insured. That is an add-on cover. And compensation by court for bodily injury and TP up to the sum insured, rest of the compensation paid by insured from his own pocket. Sum insured in motor insurance is decided on the basis of insured declared value, that is IDV. IDV means ex-showroom price less depreciation based on the age of vehicle. But in CPM, the sum insured is new replacement reinstatement cost of the vehicle of the same make and model on the current date. Both CPM and motor policies are transferable, but in case of vehicle is sold, policy can be transferred to buyer under both CPM and motor. But no claim bonus is provided in motor insurance only. There is no fund of no claim bonus in the CPM. So this is the basic difference under the policy. Now the question is escalation. Escalation is good in the CPM policy because if the value of the machine increases during the policy period, there are chances that this machine will be under insurance and average clause will be applicable at the time of claim. So to avoid this, insured has to opt for escalation. Air freight is good to opt because the insured decides to get required parts by air or quick delivery. Now who will bear the air freight charges? So if the air freight charges will be borne by the insurance company if the insured has opted for its extension to the standard policy. Similarly, floater coverage is available under the CPM policy. Floater will cover the coverage at various locations. Floater coverage, so if there is any damage at either side, the same can be covered, because contractor may be having the number of locations for project sites and their machinery must be working on all the project sites. So if the floater cover is taken at any project site, the damage to machinery is there, that will be paid by the insurance company. This is the photo of the overturning of machine, which is automatically covered in CPM, but in motor insurance it is coverable on additional premium. So this is CPM policy. Other vehicles like in miscellaneous category which are shown like lawn movers, ladders, levelers, lateral dozers, milk vans, mobile surgeries, oil and petrol transport vehicles, prison vans, refrigeration of pre-cooling cooling units, dragline excavator, drilling rigs, dumpers, dust cart, water carts, etc. They are all insurable under the CPM insurance. So if these are registered with the RTO, then in that case the policy will be issued under the motor section. If they are not registered, then the insurance company will insure them under the CPM section on the current replacement value, without IDV, without NCB, and under the respective group, because there is no classification like motor. So this is just different to the motor insurance. Thank you very much.